just as a bit of a summary as to what we've done here, there's 150 stocks under our coverage, which you're all familiar with. One-page sort of summaries on all of the key things to watch, 3 or 4 dot points on the key focus areas. Of course, where we sit relative to consensus as well, and as well as the key investment thesis for each of those stocks. This time around, we have made it a lot clearer which ones are our key stocks to watch. So we have 17 key stocks that analysts have nominated as being clear upside or downside candidates on top of the 35 broader 35 positive or negative surprise candidates. But I guess that's those 17 key stocks to watch. We've made it very clear on that second page where you'll be able to see, a short synopsis on what we're thinking about, as well as clicks and links through to each of the individual Bible pages. So have a look at that. Hopefully it's a lot clearer for you as well as your clients what we're looking out for this coming into this reporting season. So looking at these calls to action, I think it's important we start here. I guess that's what it's really all about. What are our sort of key areas where we think, tactically we can make our clients money. So a lot of names there you should be familiar with. And as Tom said earlier in his intro, the analysts have a very good track record of getting these calls right. In fact, the last half at the full year result in August, the positives were up 2.3% versus a flat ASX, and flag negatives were down 7%. So really encourage you to take a look at these calls. What's interesting this time around is there's far more positive calls than negative calls. So potentially reflecting, I guess, the resilience in earnings and the resilience that we've seen in the economy, that we're not expecting a whole lot of downside surprises, just given the momentum into the February result. And this is despite, the market rallying circa 10% over the last couple of months. So, but also, like we've been talking about, we think there's plenty of opportunities to sort of look at small caps, just given how undervalued they are, under-owned. And we do think it's time to start looking at this segment of the market. So names that we've called out as being positive surprise candidates include Acro, Alliance Aviation, James Lin Group, Qualitas, Vulcan Steel, and Tyro. Just moving through into some of the key themes. So, look, setting the scene here, the ASX 200, we're expecting earnings growth to actually decline 5% in FY24 before rebounding in FY25. So I guess taken together, the market is likely to remain range bound at an aggregate level. So unless we see a massive re-rating in the market multiple, which we don't think we'll see, given the market is trading about 16 times relative to its 14.5 20-year average, higher interest rates, etc., is likely to keep the multiple where it is. So we don't foresee a huge re-rating in the market. So I guess what that means is there's going to be far more sort of movement at the sector level. So nothing really to see at the aggregate level, but if you drill down into the sectors, we certainly think there's a lot more opportunities there. So whilst the headline level for Australia, as you can see there on the table on your left, it's not particularly compelling against peers, and hence why we see a few opportunities to really look at some international names. If you look under the surface there are a number of sectors like industrials, which is expecting about 15% EPS growth, discretionary up 8%, staples 7%, and healthcare 12%. And on top of that, we are seeing some pretty resilient earnings revisions there. So we're not seeing the negative earnings revisions that we typically see prior to the COVID sort of period. So we've given a few reasons for that in the past. Really conservative guidance and lack of guidance really makes for some pretty conservative estimates on the street. So we do think going into this reporting season that earnings will remain quite resilient, as we'll point to a few charts later on this morning. But certainly we think plenty of opportunities if you drill down and look beneath the surface. There's quite a lot of divergence between the sector performance as well as valuations across the market. So if broken down into defensive and cyclicals, as you can see there, a lot of the cyclical names, if you look at the insurance, contractors, fund managers, financial, some are offering double-digit earnings growth at what looks like to be under long-run market multiples as well. So you're getting pretty good value looking at these more cyclical parts of the market. So we certainly think these are where the opportunities and where you need to be fishing in reporting season and ahead of the new year as well. So to dive into this theme a little bit further, while we think starting valuations will matter, and we're looking for things that are a little bit more value oriented in the market, having a look at what's essentially been driving our market over the last month, and we can chalk that down to really the fundamentals. And we think this is going to be a theme sort of moving forward this year, as we have sort of mentioned last year. We've seen a real breakdown in the correlation between stocks of the ASX 200, so how tightly traded together they tend to be from a price perspective. So when they all tend to move together, the correlation's high, and when they all sort of diverge in terms of performance, it's the correlation's lower. So when obviously it moves together, it's more a macro market, and when they move in separate directions, then it tends to be a more sort of fundamentally driven market. So we've certainly seen a real breakdown in the correlation, more towards the historical average. So it's no longer the macro purely directing where the market's moving. So we think this year in 2024, it's no longer going to be holding the market and just keeping your tracking error low is going to cut it in terms of return. As we said before, earnings growth isn't expected to be stellar at an aggregate level. So we don't think the market does a whole lot. So we think a market really skewed to that top 20, that top end of the market won't really cut it in 2024. And if you look at some of the factors that have been driving the performance, it is high beta stocks. It is value-oriented stocks. It is stocks with high ROIC, so return on invested capital. So profitability and the fundamentals really are shining over the last sort of month. And if you look at some of the factors that are driving stocks lower, it is market cap. So the larger the company, the worse they perform, momentum, as well as low vol stocks. So I think if you take that together, this means that it's likely that cyclicals trading at reasonable valuations with strong fundamentals are essentially the type of companies that are going to outperform, and that really reflects our view, which will really set the tone for not only February but the rest of this year. That really sets the scene for one of our other themes, which is what to do about defensives. Now, if you think about defensives, they've been the default hiding place for the best part of 2 years, just given the weakness in the economy, the imminent slowdown, which we're told is coming. And what we've seen as of August last year, particularly through the reporting season, was defensives were the underperformer. Now, we touched on this in our reporting season review last year. But they really underperformed the rest of the market. And a few key reasons for that is because the rest of the market actually performed better than feared. Earnings were quite resilient, and we're getting earnings growth at a much broader level rather than really concentrated in just the defensive stocks. We again saw defensives underperform during that period where the Fed pivoted, and we saw a peak in what's likely to be a peak in interest rates. And expectations on rate cuts. Again, defensives were a bit of a funding source for the other parts of the market. So given our view is that, if you look at where defensive sits as a style, it's trading at much higher valuations. You're getting a little bit less growth, and you're now starting to see evidence of some negative earnings momentum. We do think other parts of the market, like the cyclicals, offers a much better spot to invest in, just given it's trading at lower multiples, you're getting better growth, and you're getting more resilient earnings. So if it's true, we are getting a much broader EPS growth across the market, which is what we're seeing. And if you look at the chart on your right, it gives you an idea, the City Economic Surprise Index for Australia, which captures the positive economic surprises, I guess, that you're seeing in incoming readings. That is trending on the positive side, and in fact, it is starting to climb as well. So you are getting far more resilient economic conditions, which we do think will flow through to earnings, and perhaps reflective of why analysts are also a lot more positive about this reporting season than previous reporting seasons. So I guess that speaks to, the more resilience we're seeing in earnings, which we think will play out in a much broader recovery in other parts of our market, and most likely the cyclicals. And then the other theme, obviously, we've talked about this quite a lot, is small caps. And if you look at the small cap sector of the market, if you look at liquidity, which you're seeing on your right, on the left-hand side, which is the amount of volume relative to the small industrials, you are seeing at a decade low. And also the performance of the small industrials relative to the larger industrials, again showing you that it's trading at a decade low as well. So I do think it is time to start looking, if you haven't already, at the small cap sector. Despite the recent rally that we've seen over the last sort of 6 weeks, it still hasn't really made a meaningful impact in terms of volumes or a recovery in its performance relative to the large industrials. So we do think, this is the place where you need to be looking. If you take that chart that I showed you a little bit earlier and drill down now into the small cyclicals rather than just the pure cyclicals, you're getting growth that's perhaps similar to the growth style, at far lower multiples, and you're getting some pretty resilient earnings as well. So small cyclicals, we think, certainly provides the opportunity. And we've highlighted some of the names. So we've asked the analysts, what are the results that you think will be better than feared, and what are some of those sort of really unloved small cap names that you think could really, it's not going to take a whole lot for them to really bounce back in performance. And they've nominated Hello World, A2 Milk, Credit Corp, IPH, Avita Medical, Clinuvel, Micro One, Veeam, Vulcan Steel, and DGL as the key candidates there. And we've talked about this before. If you look at, when rates do eventually turn, what segments of the market and what styles tend to outperform. Well, small caps tend to rally quite hard, quite early and quite aggressively. So you really do need to be on the front foot with small caps. So we do think positioning ahead of this reporting season, which we think will be a good one, is a good time to look at these names. So definitely, check out some of the small cap beats and some of the ones that we're pushing into this reporting season. And just a couple of other notable themes. Firstly, it's on REITs. It's been one of the best performing sectors over the last couple of months. And, well, I'm sure you're well aware of the issues facing the REIT sector with valuations, higher interest costs, tenancy, etc. But we certainly think we're close to an inflection point. The market's certainly warming to this sector. If you look at the relative weight of the A-REIT sector relative to the ASX 200, it's sitting also at a decade low as well, so sitting at sort of 6.2%, whereas relatively speaking, it has averaged around sort of 8 and a bit percent. So we do think there's room for a catch up there, and this is, even if you sort of consider the recent rally in REITs, it's still materially a much smaller part of the ASX 200. So we all know about the discounts to NTA, but just given we're going into the FY24 sort of first half results, a lot have reaffirmed guidance. Interest rates are now starting to plateau and in fact come down. We're not seeing those widespread downgrades that a lot in the market had been expecting. And they're all still trading at material discounts. So we do think it's time to revisit the sector, and we're seeing a few opportunities there. We've called out Qualitas, Homeco Daily Needs, Reed Goodman Group as a few examples of what to look at. And finally, looking at short interest, and we think it's an interesting theme again. Despite the rally, the market being at near all-time highs and widespread expectations of a slowdown in the economy, short sellers, interestingly, have been pulling back their positioning in their shorts. So there's really low conviction, I guess, going into this earnings season, and there's low conviction that we're going to see widespread misses, negative surprises. So that being said, however, so I guess positive from an aggregate point of view, but from a more micro sense, they have been concentrating their positions in a few high-profile growth names. So Weebit, IDP Education, WiseTech, Breville, Domino's, and Lovisa, to name a few, which I think really sets a scene for two-way price action on result day and leading up to that. They also continue to concentrate their positions in a lot of the green metal and lithium names, so Pilbara, Minres, Core Lithium, Liontown, Chalice Mining. And why I think that's important to really call out the highly shorted names, it's because short sellers have really been on the right side of the trade so far. They're getting nearly 80% of the calls right, particularly of the most shorted names. So it's really interesting. Just to pay attention, I guess, to some of the key names there. I know some of them are key network holdings as well. But just mindful that short sellers, they have been pretty right this heading into this reporting season.